All right, welcome everyone. In trading, we are always looking for that next edge. But what if that edge isn't some fancy new indicator? What if it's a totally different way of seeing the market? That's what we're getting into today, causal trading. We're going way beyond just seeing what moves together to figuring out what's actually in the driver's seat.
So here's the classic trading puzzle, right? You see two assets, and man, they are moving in perfect harmony. Asset A goes up, asset B follows right behind. Now, for years, traders have built entire strategies on these lead-lag relationships. But just watching them dance doesn't answer the billion-dollar question. Is A causing B to move, or is B causing A? Or is there some hidden third thing pulling both their strengths? This is exactly where standard analysis just hits a wall.
In this right here is the heart of the problem. See, correlation is a two-way street. It just tells you, hey, these two things move together. It's just an association. But causation? Oh, that's the real prize. That's a one-way street. It's a much bolder statement. A makes B move. One is just a statistical echo, but the other is the voice making that echo. And as a trader, you don't want to trade the echo, right? You want to trade the voice.
Now, this little distinction, it builds into a massive and, frankly, often very expensive misunderstanding in finance. Let's call it what it is, finance's correlation fallacy. And it's an error that underpins trillions of dollars in quant strategies.
And this isn't some rookie mistake that only retail traders make. Oh no, the source material for this causal factor investing makes it super clear that even the top academic papers are just jam-packed with these associational claims. Researchers find some factor, like value or momentum, that's associated with higher returns, but they almost never prove it actually causes those returns.
So what's the real danger here? Well, you end up building your entire trading strategy on what's essentially a statistical ghost. You're out there chasing a phantom relationship in the data that might look amazing in a backtest, but it just vanishes the second you put real money on the line. Why? Because it was never a real structural effect to begin with.
So how did these statistical ghosts even appear? Well, one of the main culprits has a pretty specific name, and honestly, understanding this is key to protecting your capital. So let's talk about the danger of colliders.
Collider sounds really technical, but the idea is actually pretty simple. Imagine you have two totally independent things, like, say, an artist's natural talent and their marketing skill. They're not related. But now, let's only look at superstar artists. We're conditioning on the collider, which is becoming a superstar. In that elite group, you might suddenly see a negative relationship. The super talented artist might not need great marketing, and the marketing genius might not need to be the most talented to get there. The collider itself created a fake relationship that just doesn't exist in the real world.
And that is the trap. This quote from the source material nails it. The very thing we're taught to do in statistics, controlling for a variable, can be a total disaster if that variable is a collider. You think you're making your model more accurate, but you're actually introducing bias and basically inventing a relationship that isn't there.
So what's the bottom line for us traders? It's pretty stark. If you get this wrong, if you build a model around a collider, you're not just making a random mistake. You are systematically placing bets on a false reality. You're literally trading a ghost, and that is a surefire recipe for consistent, painful losses.
Okay, deep breath. We've laid out the problem. Correlation is a trap. Colliders are lying to us. So how in the world do we find the true causal path? Well, this is where a seriously clever method called Lingam comes into the picture. And it has a fascinating little trick up its sleeve.
Okay, first, let's just appreciate the challenge. As the book Causal Inference and Discovery in Python explains, if we lived in a perfect, clean world where all data fits on a nice bell curve, a Gaussian distribution, causality would be totally hidden. The data from A causes B would look statistically identical to B causes A. There'd be no way to tell which way the traffic is flowing.
But here's the secret weapon. Financial markets are, well, they're anything but perfect, right? They're messy, they're chaotic, and they have what we call fat tails, those wild, extreme events that happen way more often than a perfect bell curve says they should. And Lingam uses this very messiness, this non-Gaussian noise, as its key. These imperfections actually leave a faint but readable trace, kind of like footprints in the snow that only point in one direction.
So how does this magic trick actually work? It's a four-step process. First, Lingam makes a critical assumption. The relationships are linear, but the noise, the random shocks, are not your perfect textbook bell curve.
Second, it uses a technique called independent component analysis, or ICA. Think of it like unmixing a cocktail back into its original ingredients. It takes the combined market data and mathematically separates it into its underlying independent shocks. Now, step 3 is where the magic happens. Because of that messy, non-Gaussian noise, this whole unmixing process can only work in one direction. It literally cannot be put back together the wrong way. And that lets us, in the final step, rebuild the real one-way street of cause and effect from the data. Pretty cool, huh?
Okay, this is all fantastic theory, but the real question is, how do we turn this powerful insight into an actual, practical trading strategy? Let's walk through the playbook.
The key here is that you don't just run this analysis one time and call it a day. The market's always changing. So the idea is to apply a version of this called direct lingam continuously, maybe on rolling 30-day windows of your data. And for every potential causal link you discover, you track something called its edge survival probability. It's just a fancy way of asking, how often does this A causes B relationship keep showing up day after day, week after week? This is how you start to separate the real, durable drivers from just random market noise. So you might set a threshold for yourself. You could say, I'm only going to consider trading a causal link if it shows up with an edge survival probability of, say, 85% or higher. This number gives you real confidence that what you found is something stable and structural, a persistent feature of the market's machinery, and not just another one of those statistical ghosts we talked about.
Now, let's be real. No model is a silver bullet. A crucial part of using any advanced tool like this is knowing exactly when and why it might fail. So let's look at the failure conditions for our new causal map.
There are really two main ways this whole approach can break down. First, if the market somehow became, well, perfect, if returns started fitting a neat, clean Gaussian bell curve, then that non-Gaussian trick that Lingam depends on would just vanish. The footprints in the snow would be wiped clean. The second danger is something called reflexivity. This is when your own strategy gets so big that your trades start moving the market. You create a feedback loop. At that point, you're not just observing the market anymore, you're changing it. The map you built is now invalid because you're redrawing the territory with every step you take.
And this brings us to a really fascinating final thought to leave you with. Methods like Lingam work because markets are messy and inefficient. But as more and more powerful algorithms get deployed, could they start to smooth out that very noise, that non-Gaussian signature that we rely on? In our collective quest to exploit market inefficiencies, do we risk creating a perfectly efficient, perfectly Gaussian, and ultimately a perfectly unreadable market? It's a huge question for the future of quant trading.